With retirement just around the corner, a thought keeps creeping in. Can I survive another crash in the stock market? It's a real concern, and you're not the only one thinking about it. The good news, if you're prepared, a crash doesn't have to derail your entire retirement. When I realized this, I stopped fearing the next market crash, no matter what happens next. And in this video, I'll show you exactly how to do the same. I'm Rob Backrack, certified financial planner, and this channel is dedicated to helping you ignore the noise and make better decisions with your money. And don't forget, if you're enjoying these videos, please hit that subscribe button. Let's start with the most crucial question, and it's not what you think. It's not, when will the Fed cut interest rates, or are we in another tech bubble? And it's not, is the dollar going to be devalued as the world's currency? And it's certainly not, is the US debt crisis going to send us into the next recession? The only question here that matters is, when will you actually need to start spending from your investments? The reason this is such a crucial question is because it's not the stock market crash itself that can derail a retirement. It's whether or not we're forced to sell our investments to cover our expenses while the market is down. Whether or not we have to sell during a down market deals with two factors. The first is when. And how long do we have until it's time to spend? According to a study done by Hartford Funds, the longest period that it ever took to regain an all-time high on the S&P 500 after one of the worst single-day crashes in stock market history was 410 days. You can see the rest of the worst market drops in history took far less time to recover to all-time highs. What this tells us is that the stock market moves quickly. And if you're a few years away from retirement, take a breath and forget about the next crash, because it's likely to be over before you've even retired. But if you're retiring soon or already retired and will need to spend from your investments, our question becomes a little bit more specific. So how do you prepare for when you will need your money? What you do is you build a war chest. Your war chest is 24 to 36 months of your income needs set aside in cash and short-term bonds. Your war chest is your safety net. It lets you ride out a down market without touching your long-term investments like stocks and real estate. Your war chest helps you relax when the bad news gets to be too much. Why 24 to 36 months? Because the average length of a bear market is 289 days. That's just less than 1 year. But things happen. For instance, during the Great Financial Crisis, the market dropped off its all-time high in late 2007, bottomed in early 2009, and had regained at least 80% of its value by late 2010. That's a 36-month window in an exceptionally horrible time frame for the US economy. But with a war chest of 36 months, you wouldn't have been forced to sell any of your investments in the stock market at a loss just to pay the bills. You'll use your cash and short-term bonds while the stock market is down and casually wait for the market to rebound. Remember, it's not about avoiding panic. It's about avoiding forced selling at the worst possible time. And when we know for certain that your income needs are covered, those scary headlines, they start to lose their power. So now you understand why the war chest matters, but here's the next question. How much do you actually need to withdraw from your portfolio to fill that gap? How much money do you need on an annual basis from your investments? Here's where most people are surprised. You might already have $70,000 or $80,000 a year coming in from things like Social Security, pensions, or rental income. Relatively fixed income sources. If your lifestyle costs per se $120,000 a year, you may only need to pull $40,000 or $50,000 a year annually from your investments. If we look at that over 3 years or 36 months, that's about $120,000 to $150,000. If you've got a $2 million portfolio, and even just if 20% of that is in cash and bonds, you may already have $400,000 set aside. So even in an extended downturn, you might already be covered for 8 to 10 years in safe, stable assets, looking at that $40,000 to $50,000 a year. But even if you needed $100,000 a year from your investments and you're in an 80-20 portfolio on $2 million, you still already have 4 years of your spending needs covered. And in that 80-20 portfolio, if the stock market doesn't crash, that 80% is in equities still working for you and growing. So either way, you're in good shape. And that's where the confidence begins. When, not if, but when the worst comes, you can rest easy knowing you already have the money you'll need set aside to avoid having to sell at a permanent loss in a down market. So now we're starting to see how just a little bit of planning can go a long way. You might be sitting there with a 70-30 or 80-20 portfolio, not realizing you already have a solid war chest in place. And once you understand how much you really need to withdraw each year, you realize you're in better shape than you thought. Now let's look at a few more ways to protect yourself and to reduce your stress about the next stock market crash. Let's talk about how you're invested. Over time, you may have built up a large position in one stock like Amazon, Apple, or Tesla, or in one sector like tech or energy. That may have helped you grow your wealth, but in retirement, when you're starting to spend from those accounts, it increases your risk of further harm when the next stock market crash comes around. And that's why it's important to diversify, but not just across stocks, across sectors, accounts, and asset classes. I get it. It's hard to sell when you're used to seeing the 1000% gain in Amazon, Facebook, Tesla, or Nvidia. Or maybe you're worried about capital gains taxes. But keep in mind, a 10 or 20% move down in Amazon or one of those other companies could be far worse than just paying a little bit of capital gains taxes. I had this conversation with a client the other day. I said, look, you bought Nvidia in 2015. You've made a ton of money. You won. It's time to take your winnings and cash in. Lock in those gains. Because one thing that we know about the top 10 companies in the S&P 500 is that the majority of them don't stay there for very long. And even though we might be thinking a company like Apple or Nvidia might not be going anywhere anytime soon, I certainly don't think so, it doesn't mean that the price of its stock is just going to go up in perpetuity. Remember what people were thinking about oil company stocks like Chevron or Exxon years ago. You would have thought, oh, there's no way that these company stocks will ever go down. We're going to always use oil forever. And you may be thinking these same things about some of these technology companies. But the reality is a lot of these companies sometimes becoming somewhat commoditized. And so their stock price doesn't continue to go up in the same way that you've been used to seeing it go up over the past 10 or 20 years. Take AT&T, for example. We can see from the chart here, AT&T was the number 1 or 2 company in the S&P 500 for a long time. It had a huge run up leading up to the tech bubble in 2000. But then, since 2000, while AT&T hasn't gone anywhere and it's still a great company doing a lot of great things around the world, if we look at the stock price from 2000 to today, the stock price is almost flat. You've had almost zero gain outside of the dividends that you've been getting from the stock. And this is something that we want to avoid from being heavily allocated into one single company. In addition to the risk that it may just come down off of its all-time highs and it could never return to those prices again. So by diversifying away from those large individual stock positions, you're just taking risk off the table. You're not abandoning growth. We're not recommending selling the stocks and moving it into cash, but you're protecting what you've built and you're reducing your downside risk by exiting some of those positions, paying the taxes if you have to, and reallocating into more broadly diversified growth style investments. Next up, here's a strategy most people and even advisors overlook. Don't invest all of your accounts the same way. You might have a 401k, a Roth IRA, and a taxable account, and they're all invested identically. But they're not the same. They have different tax rules, different withdrawal timelines, and different purposes. Your IRA might be invested more conservatively, and your Roth IRA, because maybe you're waiting for a long time for you to recoup from taxes of doing Roth conversions, might be invested more aggressively. Or even more specifically, your retirement accounts that have a tax shelter around them might be invested differently than your taxable accounts. Retirement accounts that have a tax shelter might be more appropriate for things like value and dividend-based investments, where the income earned from those investments isn't taxed on an annual basis. Whereas your taxable accounts might be better suited for more growth-style investments. Less income, less dividends, because they don't spin off as much income and therefore they can help you to create a more tax efficient portfolio inside of that taxable account. These are examples of how to diversify not just within the market and across the economy, but using different portfolios for different types of accounts is another way that you can help to reduce your risk when the time comes for the next stock market crash. Maybe one of those accounts is down more than the other, and so you could spend and withdraw from the account that is not down as much, while the account that is down waits for the rebound. And finally, what if you're more than 5 years away from retirement? Here's something most people don't expect. A market crash might actually help you. The reason for that is that you're still saving, and that means you're still buying into shares of the greatest companies in the world inside of the stock market. And if you're buying into them during a crash, you're buying in at a serious discount. And historically speaking, some of the strongest returns come right after the market downturn. Take COVID, for example. The stock market dropped 30% and then exploded into one of the biggest bull market runs in history. Investors who stayed the course often saw their portfolios grow anywhere from 30 to 100% of the pre-COVID crash levels. So if you stay invested in that example, you may actually end up retiring sooner than later. So a stock market crash isn't always a huge challenge to overcome. Sometimes they're just great opportunities in disguise. Here's the bottom line. Market crashes will happen, but if you've got your war chest, a clear income plan, diversified investments, and flexible account strategies, you don't need to be